And a very good morning, investors. You're now on KleverStock with me, Wan Izul Islam, and I'll be serving you the morning bell updates on this lovely Thursday morning. Now, we're going to kick it off with the opening bell updates for our local market. The FBM KLCI opened higher this morning before slipping into negative territory as investors balanced overnight gains on Wall Street against the lack of fresh domestic catalysts. US markets ended on a positive note with a series of economic indicators strengthening expectations that the Federal Reserve will cut interest rates next week. Now, the Dow Jones Industrial Average rose by 0.86%, the S&P 500 gained by 0.3%, and the Nasdaq Composite edged up 0.17%. In early trade, the FBM KLCI fell by 0.73 points, or 0.04%, to 1,622.11. After starting the session at 1,624.63, which was an increase of 1.79 points from yesterday's close. Bajaya Research Sidian Berhad said the benchmark index is likely to remain stuck in a prolonged consolidation phase due to the continued absence of meaningful domestic drivers, adding that the lack of impactful policy measures, major corporate developments, or unexpected macroeconomic trends has kept investor sentiment cautious and confined the index to a narrow trading band. Now, it also noted that global factors such as movements in US equities, changes in commodity prices, and major international data releases could still create some sporadic volatility. Bajaya Research also added that the index has formed a bearish candlestick, extending its longer-term consolidation pattern, with gains expected to stay capped unless the index can break above the immediate resistance of 1,632 points, followed by 1,638 points, while the near-term support levels remain at 1,612 and 1,600. Broader sentiment is expected to stay mixed, with investors selectively accumulating oversold and beaten down stocks in hopes of short-term rebounds. Rakuten Trade said that the sentiment also appears cautious as traders wait for clearer signals from the United States before increasing exposure. And it also expects the index to move within the 1,620 to 1,630 range today. Among the decliners in early trade, Malaysian Pacific Industries, they slid by 56 cents to 31 ringgit 92 cents. United Plantations eased up 12 cents to 28 ringgit 42 cents. Tenaga Nasional dipped by 6 cents to 12 ringgit 78 cents. And Ralco declined by 6.5 cents to 70 cents. Up on the gainers list, Nestle climbed by 1 ringgit 40 cents to 118 ringgit. Hong Leong Financial Group advanced by 14 cents to 17 ringgit 88 cents. Kellington rose by 11 cents to 5 ringgit 19 cents. And PPB Group added 8 cents to 10 ringgit 6 cents. PSP Energy, which made its ACE market debut, slipped by half a cent or 3.13% to 15.5 cents, with 48.43 million shares changing hands, making it the most actively traded stock on Bursa Malaysia today. We're moving on now to some Forex updates. The ringgit opened stronger at 4 ringgit 11 cents level against the US dollar this morning as markets increasingly priced in the likelihood of a United States monetary easing next week. At around 8 a.m. this morning, the local currency was trading at 4.11 or 4.12, an improvement from Wednesday's close of 4.12 or 4.1235. Now, Bank Muamalat Malaysia Berhad Chief Economist Muhammad Abzanizam Abdul Rashid, he said the US dollar index fell by 0.48% to 98.88, signaling rising expectations of a Federal Reserve rate cut. He also noted that the latest ADP employment change data showed private sector job creation contracting by 32,000 in November, a development that points to a weakening labour market and strengthens the case for monetary stimulus. Now, the ringgit touched a fresh 14-month high on Wednesday when it closed at 4.12, supported by sustained anticipation of a Fed rate cut that has continued to pressure the dollar. On a year-to-date basis, the local currency has appreciated by 8.5%. Abzanizam said the ringgit is likely to remain firm today and could trade within the 4 ringgit 11 cents to 4 ringgit 13 cents range. At the opening bell this morning, the ringgit showed a mixed performance against major currencies. It eased to 2.6499 or 2.6565 against the Japanese yen. It slipped to 5.4852 or 5.4986 against the British pound. However, it did strengthen slightly against the euro to 4.7947 or 4.8064. Against ASEAN currencies, the ringgit traded higher across the board, appreciating against the Singapore dollar to 3.1767 or 3.1847. It also firmed up against the Indonesian rupiah to 247.1 or 247.9. It also rose against the Philippine peso to 6.97 or 7.00 and advanced against the Thai baht to 12.8780 or 12.9190. Now we're going to be moving on to some local economic news. Malaysia's economy is sending mixed but manageable signals as slowing credit growth contrasts with a strong trade performance, creating conditions that allow Bank Negara Malaysia, BNM, to maintain its current policy stance while monitoring signs of cooling momentum. Now, loan growth in October eased slightly to 5.4% year on year, down from 5.5% in September and averaging 5.3% over the first 10 months of the year. For 2024, total loan growth stood at 5.9%. Now, CIMB Treasury and Markets Researcher Senior Economist Azri Azhar said the slowdown is broad-based, affecting the households, wholesale trade, accommodation and food services, transportation and storage, as well as business lending, which he noted has clearly lost momentum. Now, business loan growth eased from 5.5% in September to 5.2% in October, while working capital credit weakened further from 3.8% to 3.2%. A similar moderation was seen in credit applications and approvals through the second half of 2025. Azri also noted that such broad-based softening has historically preceded interest rate cuts, as firms tend to pull back on spending and investment when borrowing slows. However, he also emphasized that other key indicators show no immediate need for Bank Negara Malaysia to loosen their monetary policy. Now, trade remains one of the economy's strongest pillars, with exports surging 15.7% in October and imports growing 11.2%. That's fueled by stronger electrical and electronics demand and smoother trade flows after the US tariff deadline in August. Now, inflation trends further support Bank Negara Malaysia's ability to stay on hold. Headline inflation averaged 1.4% in the first 9 months of the year, with forecasts standing at 1.5% for the year 2025 and 2% for 2026. Now, while core inflation has firmed slightly due to mild labor tightness, overall price pressures remain modest. Azri said that this gives Bank Negara Malaysia room to see or to ease should growth conditions weaken, pointing to a growing, though not urgent, bias for potential easing in 2026. Now, the moderation in business and working capital loans suggests softer investment momentum ahead, but not enough to signal a turning point for the broader economy. University Technology Mara Senior Lecturer Dr. Muhammad Itham Muhammad Razak, he described the current environment as a natural post-pandemic normalization. After several quarters of strong credit expansion tied to reopening dynamics, pent-up demand and business restocking, he said that credit growth is now settling into a more sustainable trajectory. He also noted that healthier household financial behavior with less dependence on debt for discretionary purchases and also more strategic borrowing among businesses transitioning from recovery to long-term planning. Now, according to him, the data also reflects a maturing credit cycle, with the banking system continuing to support growth at a steady pace. Employment, domestic spending, as well as investment intentions, he added, still point to economic resilience rather than economic stress. Now, CIMB Treasury and Markets Research expects that GDP will grow to 4.5% in 2025 and 4.1% in 2026, supported by domestic demand, seasonal consumption patterns, and also the government's 100 ringgit cash transfer scheduled for February next year. In line with this outlook, it expects the overnight policy rate, or the OPR, to remain unchanged at 2.75% through the first quarter of 2026. Bank Negara Malaysia last adjusted the OPR in July with a 25 basis point cut to support recovery amid soft global conditions. Now, Azri said another 25 basis points cut is likely in the second quarter of next year, possibly at the May Monetary Policy Committee meeting, if the deceleration in business activity continues. If credit momentum cools further, he said the case for policy easing would become more compelling. We're moving on now to some corporate news updates. E.co is strengthening their position as a central enabler of Malaysia's dual 5G deployment, supporting both Digital Nasional Berhad (DNB) as well as U-Mobile as the country moves into a two-network model. Acting as a neutral host, the company enables operators to share infrastructure rather than build duplicate sites, a role that becomes increasingly important as nationwide 5G expansion accelerates. Now, E.co currently manages more than 6,500 structures across Malaysia, with over 14,000 tenancies, achieving a co-location ratio of 2.3 times. According to E.co's Director of Malaysia Business, Gayan Koralaje, the company has already delivered about 2,000 sites each for DNB and U-Mobile, amounting to nearly 1/4 of the entire combined 5G rollout. Alongside outdoor expansion, E.co is upgrading 470 in-building systems in locations such as airports, malls, hospitals, universities, as well as transport hubs in response to growing indoor 5G demand. Now, Koralaje, he said that the company remains focused on supporting both DNB's capacity needs as well as U-Mobile's second 5G network to ensure strong coverage and long-term resilience, while also prioritizing indoor connectivity where most data consumption occurs and where nearly all 5G use cases are expected to emerge. Now, E.co is planning further footprint expansion in Kelantan, Terengganu, Sabah and Sarawak, with up to 40% of new built-to-suit sites projected to come from public-private partnerships. Now, the company emphasizes data-driven decision-making through its Network and Planning Analytics Platform, or NAPA, which evaluates network performance, traffic patterns, geospatial information, and also population density to determine the best possible tower locations. Koralaje, he said that operators gain access not just to more sites, but to the right sites. As concerns rise that 5G development may remain overly urban-centric, E.co argues that rural economics require a different strategy, one in which tower sharing is essential for commercial viability. About 30% of edotco's towers are already located in rural areas, which gives the company a strong starting point for preparing undeserved regions for 5G. Instead of building entirely new infrastructure, many of these rural towers can simply be upgraded, reducing both deployment time and also environmental impact. Now, the company is also testing alternative technologies in areas where conventional towers are not feasible. For example, in Sungai Kelit, Raub, Pahang, edotco collaborated with Zeta iOS to implement fixed wireless access supported by Starlink backhaul, delivering at least 100 megabytes per second connectivity to an Orang Asli community of 150 people. In Uma Lesong, Sarawak, a hybrid system combining Starlink point-to-point links with fixed wireless now provides internet access to 1,300 residents living in 140 longhouses, and to date, edotco has completed 133 towers under the National Fiberization and Connectivity Plan, 258 towers under the Jendela Phase 1, 239 kilometers of clawback 19 fiber, contributed roughly 25% of DNB's total 5G rollout, and managed 60 NADI centers. So, looking ahead, the company, edotco, expects to support the government's goal of expanding 5G coverage to 80% of populated areas under the 2026 budget, including the deployment of 2,700 additional Jendela Phase 2 sites and further fiber expansion for public sector services. Now, edotco's evolution has progressed through 4 stages. Its establishment as an Asiata carve-out in 2013, expansion into South Asia by 2016, a strategic rebalancing towards Southeast Asia beginning in 2019, and its current phase focus on value creation and monetization. Now, the recent divestment of its Myanmar operations reflects a shift towards strengthening portfolio resilience and also reinforcing its position as a regional neutral host. Koralaje, he said the company is now prioritizing asset optimization, improved tenancy ratios, and a deeper role as a neutral host that enables cost-efficient and sustainable connectivity for mobile network operators throughout the region. Finally, we'll be wrapping it up with some major corporate developments and deals across Malaysia. Keep your eyes open. So at number 1, we've got Gabungan AQRS. They've inked a joint venture with Rising Charm Sedian Berhad for a 600 million mixed development spanning residential, commercial as well as retail components in Bangi. Now, the project, set for 2027, will be funded through internal funds, property sales as well as bank borrowings. Our next headline at number 2, Sumi Saujana. They've secured a 3-year call-out contract to supply specialized chemicals and services to Pengerang Refining Company. At number 3, the headline reads, Tuffy Industries is selling its Muar land and factory for 23.5 million ringgit as it exits loss-making furniture manufacturing to focus more on property and construction. Our next update is MBL. They're acquiring 2.26 acres of industrial land in Muar for 9.5 million ringgit. That's to expand capacity and also support growing demand. Our next headline, Wasco won a contract from Technip Energies Italy estimated at 619 million ringgit to 826 million ringgit for a pre-assembled module works. Well done to Wasco. That is a wrap-up for the Morning Bell updates with me, Wanizul Islam, right here on KleverStock. Thank you so much for choosing us, investors. Stay tuned for more live coverage coming soon. We've got a lot to catch up on, and we'll see you later. Have a great day ahead, and we'll see you soon.